All right, welcome back. It's time for another deep dive. And today we're tackling something you've been wrestling with.
Oh, sounds intriguing.
It is. So we're going deep on idiosyncratic risk, especially with all the GameStop stuff you've been looking at. And since you're a financial pro, we're going to skip the basics right to the meat.
Love it. Straight to the good stuff.
Exactly. And the stuff we've got is juicy, a whole SEC report, and then a super intense Reddit thread. Talk about a combo.
Ooh, yeah, that's a powerful mix right there. I'm really curious to see what we can dig up from those two.
Oh, get ready, because it gets a little wild. First up, that SEC report. I was honestly floored to see GameStop mentioned in the FSOC annual report, the 2021 one.
Well, hold on. That's not your typical FSOC thing. I mean, they're all about systemic risk, the whole financial system stuff. Why single out GameStop, one company?
Exactly. It made me think they must have seen something, some kind of ripple effect potential there.
Yeah, you don't just casually name drop GameStop in an FSOC report. There's got to be more to it.
And there is. They go into how retail investors all over social media were creating massive volatility in, those meme stocks. That's where this idiosyncratic risk thing comes in, right?
Oh, absolutely. I mean, theoretically, idiosyncratic risk should be contained to that one company.
Yeah.
GameStop doing its thing shouldn't rock the entire market, at least in theory.
Right, in theory. But this whole case, it shows how company-specific risk can become like a systemic thing.
Yeah, it breaks the mold a little bit, doesn't it? Like those boundaries get blurred.
Totally. And the report even points to those financial innovations that have eased access to these markets. Made me think of those commission-free trading apps right away.
Oh, for sure. Those apps, they've changed the game. Open the doors for everyone. But the thing is, they amplify everything. The good, the bad, all of it.
Right. So like more rewards, but also way more risk if something like, well, GameStop happens.
Exactly. It's a textbook example. Huge price swings. And
Yeah.
it's all driven by those retail investors. Power in numbers, right?
Yeah, it's crazy. Okay, so time to jump into the Reddit trenches. You sent me this thread from our super stonk where they're comparing GameStop to, get this, the crazy price action of AMTD Digital, HKD.
Whoa, the irony there is kind of mind-blowing, right? Reddit, the folks often blamed for the whole GameStop idiosyncratic risk thing, they're now saying HKD is, like, manipulated.
It's a total role reversal. They're pointing fingers saying, hey, look over there.
It's like they've become the market watchdogs now, keeping an eye out for anything fishy.
Totally. And they're onto some interesting stuff. They're saying HKD had these wild price swings, but on super low volume. Doesn't that seem, off?
Yeah, that's a major red flag right there. Like, if a company's value is supposedly shooting up, you'd expect a ton of trading, right? That low volume makes you wonder, is it really genuine investors driving those changes?
Right. And then some users are even saying there's a link between HKD's underwriters and, get this, hedge funds. They're talking about a pump and dump scheme.
Uh-oh. Those are some serious accusations. We got to be careful about jumping to conclusions, of course.
Of course. But you can't ignore the context either. I mean, GameStop made a lot of retail investors, distrust those traditional players.
Yeah, they're looking at everything with a skeptical eye now. Like, is this another GameStop?
Yeah, exactly. It's like they're on high alert for any sign of manipulation.
And, that kind of scrutiny, while it can lead to some unfounded theories, it also keeps everyone on their toes, makes the market more transparent.
Definitely a double-edged sword, I guess.
Hmm.
But going back to idiosyncratic risk, how do these accusations about HKD and that low trading volume, how does that all fit in? Can a company with barely any trading actually be a systemic threat?
That's the million-dollar question, isn't it? It's especially relevant when we're thinking about GameStop. Like, if HKD is just a case of crazy idiosyncratic risk and it's all organic, then the broader market should be okay, in theory. But if someone's pulling the strings, if there's manipulation,
Then it's not just about HKD anymore, right? It's about that manipulation potentially spreading, causing a domino effect. It becomes that question of, can idiosyncratic risk become systemic, like some people worried with GameStop?
exactly. Because those fake price movements, they can send the wrong signals, make investors lose trust, and ultimately, it messes with how capital is allocated. And after GameStop, everyone's a bit more sensitive to this kind of thing.
Yeah, no kidding. So this Reddit thread also points out a big difference between HKD and GameStop.
Yeah.
There wasn't a lot of short selling or options activity with HKD. Does that change anything?
Oh, it's a biggie, especially when we think about how GameStop went down. A huge part of that squeeze was those hedge funds and their massive short positions. And when all those retail investors piled in,
Just blew up, right? They had to buy shares to cover their positions, and that just pushed the price even higher.
exactly. So with HKD, without that huge short interest, it's a different situation. Not the same setup for an explosion like GameStop. It's a different beast altogether.
So, not a GameStop 2.0. But does that mean we can just, like, relax?
Well, not so fast. No short selling might make a squeeze less likely, but there could still be other kinds of manipulation going on.
Okay, yeah, like those pump and dump schemes we talked about.
Yeah.
But going back to the Reddit thread, they keep bringing up HKD's crazy low volume, even with those price swings. It just seems, I don't know, backwards.
Yeah, it definitely raises some eyebrows. I mean, you'd think if a company's value is skyrocketing, there'd be tons of trading going on, right? But with low volume, it's like, what's really driving those prices?
Exactly. And then some of those users, they went a step further, right? Talking about connections between HKD's underwriters and hedge funds, even suggesting a pump and dump scheme.
Yeah, those are some serious accusations. It's a reminder that we can't just take everything at face value.
Right. But after GameStop, it's like a lot of those retail investors, they're looking for these kinds of things.
Oh, absolutely. They're way more skeptical now, especially when they see those crazy price movements. Like, they're thinking, wait a minute, is this another GameStop situation?
Exactly. It's like they've got their detective hats on looking for clues.
And that kind of scrutiny, it can be a good thing. It keeps the market honest, forces everyone to be more transparent.
For sure. But how does this, like, potential for manipulation, how does that tie into this whole idiosyncratic risk thing?
Yeah.
And especially with GameStop as our, like, reference point.
Right. It all comes back to that. See, if HKD is just super extreme idiosyncratic risk and it's all driven by real investors, then theoretically the rest of the market should be fine. But if it's manipulation...
That's a whole different ball game. Like,
Yeah.
suddenly it's not just about HKD anymore, right?
Exactly. It's like, can they use manipulation to turn idiosyncratic risk into something systemic? Kind of like that fear with GameStop.
It's like they're weaponizing it almost.
Yeah, that's a good way to put it. GameStop showed us just how powerful idiosyncratic risk can be in this interconnected world we live in. And now, with HKD, it's like, what if someone's deliberately making it worse?
It's a scary thought.
Yeah.
But hold on. The Reddit thread also mentions that there wasn't a lot of short selling with HKD or options activity, unlike GameStop. Does that actually matter?
Oh, it's huge. Remember, GameStop blew up partly because of those hedge funds and their massive short positions. When all those retail investors jumped in, it triggered this chain reaction.
Right. They had to cover their positions, and that just pushed the price up even more. It was crazy.
Yeah, it was a perfect storm.
Yeah.
So with HKD, without that same level of short interest, you don't have the same ingredients for that kind of explosion.
So no short squeeze, but does that mean manipulation is off the table?
Well, not necessarily. It just means it might look different. It might not be a GameStop-style squeeze, but there could be other ways they're manipulating the market.
Okay, so other ways. Like what what are we even talking about here?
Well, think about it. We already talked about pump and dump schemes, but it could be even more complex than that. They could be using algorithms, spreading rumors, or even exploiting loopholes in the system.
Whoa, this is getting deep. So what does all of this GameStop, HKD, manipulation, what does it all mean for, like, the average investor and for the financial world in general?
It really highlights how much the market has changed. It's not just about big institutions anymore. Retail investors, social media, it's all a huge part of the game now.
Yeah, and it feels like things are changing so fast. Like, how do we even keep up?
That's the challenge, right? Traditional risk management, it's like looking in the rearview mirror. We need to be looking ahead, anticipating what's coming next.
It's like we need a crystal ball or something.
Well, maybe not a crystal ball, but definitely a new way of thinking. We need to be more proactive, more dynamic in how we approach risk.
Okay, I'm with you, but what does that actually look like? Like, how do we actually do that?
For starters, we need to be more diligent. We can't just rely on the old metrics anymore. We need to understand the forces at play. Social media, retail investor psychology, the potential for manipulation. It's about connecting the dots.
It's like we need to develop this, like, sixth sense for risk.
Exactly. We need to be able to spot those subtle signals, those things that traditional models might miss.
I like that, a sixth sense for risk.
Yeah.
So how do we develop that? What are the steps?
It's a combination of things: continuous learning, critical thinking, and a willingness to question everything.
Okay, so stay informed, question everything, be adaptable, but how do we turn that into, like, actual strategies?
Well, for individual investors, diversification is key, and not just across asset classes, but also across risk factors. Think about incorporating alternative data sources, like what's happening on social media, into your analysis. And be ready to adapt, because things can change quickly.
So it's about being flexible, thinking outside the box.
Exactly. And for those of us in risk management roles, we need to push for more transparency, develop better surveillance systems, and work together. Regulators, market participants, tech companies, we all need to be on the same page.
It's a team effort.
It is. And at the end of the day, it's about protecting the integrity of the market. Because if people lose faith in the system, that's when things really start to fall apart.
Yeah, GameStop showed us that, right? How fragile things can be.
Exactly. It was a wake-up call. And these conversations, they're important. We need to keep talking about these issues, keep learning, keep adapting.
Couldn't agree more. So where do we go from here? What's the next step in this whole evolution of risk management?
Well, I think we need to start thinking about risk in a more holistic way. It's not just about numbers and models anymore. It's about understanding human behavior, the impact of technology, and the interconnectedness of everything.
It's like risk is everywhere, right? It's not just in the spreadsheets anymore.
Right. And that's why it's so important to be vigilant, to be proactive, to be constantly learning and evolving.
This has been a wild ride. And a little scary, honestly, but also kind of exciting. Like, we're on the frontier of something new here.
I think you're right. We're at a turning point. And how we navigate these challenges, it's going to shape the future of finance.
So what's the takeaway for our listeners? What can they do to prepare for this new world of risk?
I think the most important thing is to stay informed, to stay curious, and to never stop learning. Because the more you understand about how the market works, the better equipped you'll be to navigate these challenges.
Words to live by. So we've talked about GameStop, we've talked about HKD, we've talked about manipulation, and this whole new era of risk. It's a lot to process. What's the one thing you want our listeners to walk away with today?
That idiosyncratic risk, it's not just a theoretical concept. It's real, it's powerful, and it can have a huge impact on the market. And in this interconnected world, it has the potential to become a systemic issue. So we need to be aware of it, we need to understand it, and we need to be prepared to deal with it.
Great advice. Well, we've covered a lot of ground today, but as always, the learning doesn't stop here. I encourage everyone listening to keep digging, keep asking questions, and most importantly, stay engaged. This is a conversation that's just getting started, and we'll be here to guide you every step of the way until next time. So, wow, we've really gone deep, haven't we? From GameStop to HKD and all this talk about manipulation. It's clear that idiosyncratic risk, especially when it might be, manipulated, it's a big deal. But let's bring it back to our listener. They're the financial expert here. How do you see all of this playing out in the real world?
These situations, GameStop, HKD, they show us just how much things have shifted. Retail investors are a major force now, and with the speed of information and the way markets are connected, we got to rethink how we approach risk.
Yeah, like what used to seem isolated, a blip on the radar, now it could have huge ripple effects. It's almost like we need to rewire how we think about risk.
Exactly. And for someone like our listener, a financial pro, that means being way more proactive about risk.
Okay, I get that, but what does that actually look like? Like, how do you actually DO that?
Due diligence is key, more than ever. You can't just rely on the old ways, those traditional metrics. You got to understand the whole picture. Social media, how retail investors are behaving, and yeah, that potential for manipulation.
So it's like developing this intuition, the sixth sense for risk.
So, spot on. Being able to pick up on those subtle signs, the things that the models might miss.
Okay, sixth sense. I like that. But how do we actually, train that sixth sense?
It's a journey. Never stop learning, always be thinking critically, and never be afraid to question assumptions. Those are your tools.
So stay informed, be skeptical, and be ready to adapt.
That makes sense. But how do we translate all of that into actual strategies? What do we do?
Diversification is huge, not just across different types of assets, but different kinds of risks too. Think about using alternative data like social media sentiment in your analysis and be ready to adjust your strategies on the fly.
So agility, flexibility, thinking outside the box. It's a whole new ballgame. And for anyone in risk management, it's about pushing for more transparency, creating better systems to monitor things, and working together. Regulators, people in the market, tech companies, we got to be on the same team.
Yeah, collaboration is key. We're all in this together.
Exactly. Because at the end of the day, it's about making sure the market is fair, that it works for everyone. Because if investors lose trust, the whole thing can unravel.
GameStop was a reminder of that, wasn't it? How fragile things can be.
It definitely was. But, having these conversations, talking about these challenges, that's how we learn and adapt.
Well said. So, after this deep dive, after all this talk about GameStop, HKD, and the future of risk, what's the one thing you want our listeners to take away?
That idiosyncratic risk isn't just some abstract concept in a textbook. It's a powerful force, and it can have a huge impact on the markets. And in this crazy interconnected world, it can turn into a systemic problem. So be aware, be prepared, and never underestimate its power.
Couldn't have said it better myself. Well, this has been an incredible journey. But like always, the learning doesn't end here. To all our listeners, keep exploring, keep asking those tough questions, and most importantly, stay engaged. This is a conversation that's just getting started. We'll be right here with you every step of the way. Until next time.